I've been investing for long enough to realize that almost anything can really happen in the market. I bought my first stocks in the early 1990s when I was barely a teenager, using my dad to count. I was always drawn to stocks and investing because I found it exciting and would much rather own investments than stuff. I've been here for a while and have witnessed some crazy things, like the dot-com bubble, even though I wasn't in the market at the time. Instead, I was playing with various internet stocks after the crash. A few examples of these include the company I owned, Macromedia, which I owned until it was acquired by Adobe. Furthermore, experimenting with alternatives with them during that period. Overture, a search engine that pioneered pay-per-click advertising, was another firm I had stock in. I also had options in other stocks, such as Microsoft, but AskJeeves.com was at the bottom of the .com. Ask.com was once known as Crash. In case you couldn't figure out that was a 1,500 times return, the stock increased by roughly 50 times before IAC bought it, and IAC increased by about 30 times after that, or around 2021. However, we did sell out and take profits as the stock increased, only learning a valuable lesson, but still a 10 times return on average. We're primarily investing in real estate back then, commercial property, but these first-hand experiences add to your own investing knowledge and know-how. I've read so many books on investing, trading, hedge fund management, technical analysis, etc., and you know what? A lot of them say the exact opposite to one another. Still, a 20-year hold was not easy. In fact, IAC didn't do much for the first 15 years either. Then, when the global financial crisis hit, I was holding stocks and actually dumped my portfolio early in that crash before it got much worse. Works while someone else claims the same technique doesn't. In other words, you have to devise a plan that works for you. This is true for many things in life, such as dieting, where you might want to try keto or something similar. Start off by losing a little weight, but you'll soon realize that's not sustainable. You need to find the proper balance between your body and lifestyle. Similarly, when it comes to investing, you need to choose the right strategy based on your goals and stress threshold. Your intelligence and knowledge, some of these hedge fund managers have absolutely insane intelligence and can calculate massive equations in an instance in their head. It means they can see numbers different from you. It's likely you or I don't have that same skill set, so we can't use what works for them. You have to use what works for you, and you have to discover your own strategies. And this is how a lot of hedge funds work. The manager has some sort of strategy that is unique and ends up averaging 16 returns over a decade or so. There may be investors you listen to now, perhaps some that are waiting for Tesla to dip below 100 and then buy, although that opportunity is looking less and less likely. And that may have been an incorrect strategy, and they may be mocked for insinuating such a thing, except they may also be worth tens of millions of dollars, because in the past, this strategy has worked for them. And although it doesn't work every time, it's worked enough times, and that's just their strategy. When investors, then you probably listen to many others on top of that, but you should only be listening to them in order to mold your own strategy, understand what and why a strategy is working for one investor, and use that to enhance or experiment with your own strategy. And all you, since many of the cryptocurrency millionaires are only one lucky investment. Many of you listening believe you're so smart that you can outsmart Warren Buffett and beat him at investing for the remainder of the decade and earn far higher returns. Really, the Oracle of Omaha? Well, if you're a serious investor with the necessary experience and knowledge, you probably can. Buffett's returns are hampered by the size of the sums of money he manages. It's much simpler to earn a higher return on $1 million than $1 billion, let alone hundreds of billions. Buffett only needs to beat the index funds to win over his investors, and he already has his way. In fact, a good analogy that I like to use is that of golfers. Younger players typically win tournaments, so why don't the older players hit the ball farther and more accurately? Because the older players have more experience, which can sometimes work against them. Buffett plays it safe with value stocks, whereas some of you are all in on Tesla right now, hoping or almost guaranteeing that you'll get about 3%. The younger golfers try to clear the woods or water hazards with one shot, whereas the other golfers are less likely to take that risk and shoot around it in 2 shots. Why? Because they've had too many experiences where they didn't make that shot and their ball ended up in the drink or something. To be honest, I'm not sure if that is true, but I read somewhere, so it probably is. But it's a moot point 10 times return on your investment by about the end of this decade. And think, but it is stupid for not investing in Tesla, or sometimes even speculating that he is investing in Tesla. When the stock starts running, I also had the majority of my net worth in tested too, but only because it appreciated so much when I started, I mean 20 times in just a few years. Who would have thought that I didn't? I thought 10x by perhaps mid to late 2020s. If things go well, oh, but some people did, or were closer, like Kathy would write, yeah, she was mocked for believing in such a story, except it happened, she got crazy returns on Tesla with a huge investment, and then became extremely popular. People thought ARK was the fund to invest in, with Kathy Wood being the closest thing to a crystal ball. She was right, except not for the right reason. You see, for my forecasts, I predicted those returns solely on EVS back then. FSD felt to me too hard to believe, but EVS, I was sure would be the future. They were a better version of a car, plain and simple, and Tesla were going to get the costs down to 35,001 with great margins. So I believe everyone would want one. Whereas Kathy, well, she was sold on the robotaxi and FSD potential, and her numbers all factored in those. She was totally wrong, except she was right at the same time, just for the wrong reasons. ARK's latest predictions again include rubber taxes, so I think they are a waste of time. They don't know when they'll be solved, just like Elon doesn't appear to know. So how would ARK know any better? No one knows when FSD is solved. ARK got lucky because anything can happen in the market, and you can make asymmetric investments or bets in that if FSD is solved, you make 10 times your money on Tesla if fiat money collapses. You could be able to increase your Bitcoin holdings by 10 or even 50 times potential upside to outweigh the drawbacks, but Warren Buffett doesn't invest that way. However, his method of slow and steady compounding has clearly been very successful. Can FSD be safer than a human? Elon tells us that we are already at 99.9 in the March of Nines. How are we measuring this, as it's an arbitrary way to measure? What about the number of journeys that don't require interventions? Are we even at 90 there yet? I don't think so. We may not even reach the first 9 in that regard. Additionally, since it's a logarithmic rather than exponential progress, I don't even own FSD, let alone FSD beta. Furthermore, I'm not an expert in AI, so anything can happen. In terms of Tesla, hopefully we've seen the worst that the economy and market can provide. At the absolute least, the stock has persevered through its comeback. It took some time, but it seems that Twitter had a greater impact on the stock price than the fanboys who supported Elon Musk's free speech position claimed. While it's wonderful that we can tweet more freely these days, the fact that it still damages some of us and costs us millions of dollars remains. Supporting the cause is considerably simpler when you own a few hundred shares and have decades before you have to consider retiring. Given that Tesla's stock is as high as it is, there will probably be more ups and downs. Twitter was almost like a black swan event for the company. Who would have imagined it would have happened downs? But at least now we have a clear picture of how the market assesses Tesla under a variety of conditions.